Thank you for the invitation. It's an impressive heads up that you've given here for the speakers in your seminar series. So I hope this morning's event will be interesting for you too. Just a very small correction on my future agenda. We've sort of stopped the process. I will be boarding UBS already in May this year as chairman. And so it's been brought forward by a year. You may have seen that there were some changes at the institution over the last few months. So I'm now in my transition for the next 3 months, 4 months to basically get to know the country better, get to know the people better at the bank, and hopefully we'll be able to contribute to the institution. Now, what we talk about here, I'd like to give it, because you started off with the European dimension, and I'd like to take a step back from that. Because the European dimension clearly is where at the moment the focus of markets is, where the heat in the market is currently being felt, but nobody around this table should kid themselves that this is a European problem. This is a much more general problem, and we've seen that problem in different rounds take hold around the globe when we talked about the financial crisis over here. The start of the financial crisis in the US, many Europeans said, oh, this is a US crisis. This is a US debt crisis. This is a US mortgage market crisis. And then it became a global recession. It became a global financial crisis. And I would make the argument that this is not a new crisis. This is just the next round of that same crisis that we've seen emanate here in financial markets in the US. And again, don't kid yourself that that is the last chapter of this crisis. Financial crises usually take twists and turns, and they usually have the nice feature that they start affecting segments of markets which up to that point were solid and not facing any problems. But as this crisis plays out and as actors react optimally in their own interest to events, they start impacting with their decisions on other market segments. So we're not done yet. We'll see more. This is a general global crisis of finance and the conjuncture. The one reassuring thing, I just talked very quickly with my esteemed colleague here, Mr. McKibben, the one thing that we've seen is it has no currency dimension so far. Why not? Because these are all the standard, the most established currencies. These are the reserve currencies of the world, first the United States and now Europe. The reserve currency status has helped these countries to not see major realignments in these markets, because for many people around the globe in emerging markets and many other market segments, there isn't really a lot of alternatives to being invested in the G7, G20 countries and in the reserve currency countries. And that's why during all these crises, the exchange rate between the euro and the dollar has been holding up pretty surprisingly. If you ask many, given previous experience in financial crisis in Asia, in South America, the Mexican crisis, a major adjustment of the exchange rate of that region relative to all the other regions of the world was upfront one of the main adjustment mechanisms. It hasn't happened so far because these are the reserve currency countries in the world. And so risk-return calculus for many financial market investors is just totally different. Safe haven status has helped these countries to basically not see a currency dimension so far. And let me also make the very clear point that if you plot out in deficit and debt space the countries that are now in focus, debts and deficit in the last year, you get constellations of around 100% debt levels and 2-digit deficits. That is the speed at which you add to these debt levels per GDP. You see Portugal Island, Spain, and Greece in that region. But you also see 2 other countries in that region, the US and the UK. And actually way above that, you see Japan, which has a much higher debt to GDP ratio, not as high deficits now. So investors around the globe and citizens around the globe shouldn't kid themselves. This is not a European problem. This is a problem of excessive debt, which has been built up in a run of growth around the globe that we haven't seen for 25 years. The years 2002 to 2007 saw an unprecedented 25-year unprecedented run on growth in most of our economies. And during that period, not just the private sector, the public sector got leveraged. And we've seen booms in market segments that basically now, in some segments, have ended in a bust. And it's the workout of that bust in some market segments that is causing all these problems. Over-enthusiastic prolongation and extrapolation of current trends into the indefinite future, and therefore borrowing on the future. And as these trends break, and as the economies normalize and financial markets come down, so has to come down the expectation on how this is sustainable. So people are adjusting. People are deleveraging. Countries need to delever. And in that process, of course, prices are adjusting in a major way. And that's what we're seeing now. So when this whole thing broke out, my feeling was no country around the globe can feel safe. High deficits and debt are an issue not just for the Eurozone, they're an issue for the UK, the US, and Japan likewise. The question of sustainability has arisen in these countries, and I'm going to talk briefly why it has arisen, but it will not be limited to those countries. Second, structural rigidities, which are a key feature of the countries we talk about in Europe, they're not very flexible. They have labor market problems. They have product market problems. Their business model as a country, their future growth perspective is much more meager than it is for the other countries I just mentioned, the US, the UK, and Japan, which are much more flexible. So the problems on how to get out of this can be easier managed in countries like the US, the UK, and Japan, rather than structurally rigid countries in Europe, some of the peripheral countries. But the difference is a difference of degree. It's not a fundamental difference, it's a difference to degree. Now, the way this is playing out, I'd like again to go back to the comparison to the US financial crisis. The US financial crisis started in a very narrow segment of financial markets, the subprime mortgages. And when the mortgage market turned and prices fell, it was pretty clear that those, in particular the late mortgages generated in 2006, 2007, at the heat of the boom, would not be serviced. And it affected not just subprime mortgages, it affected Alt-A mortgages pretty quickly down the road. Sooner than later, it was an issue for the prime mortgage market. And actually, it didn't stay in mortgage markets, it moved to commercial real estate as well. And after it sort of emanated and affected pricing in every market segment of the housing market and mortgage markets, it became a global problem because similar booms were there in Spain, in the UK, in France, and many other countries that came to an end just like the mortgage boom came to an end here. And in my view, what has happened in the mortgage markets is now happening in the sovereign debt markets. You can call the Greek event a subprime sovereign debt wake-up call in the sovereign debt market. It has been affecting Alt-A sovereign debt instruments, those that are not AAA, in countries like Spain and in countries like Italy. It is affecting now in Europe the prime sovereign debt markets, and even a German auction, largely failed a few weeks ago, where 80% of the auction could not be sold at a target price. And France, Germany, Austria, and the AAA countries who fully stand behind the financial firing power of the Brussels vehicles, of the European stability mechanism in the future, their quality of signature has been called by the market and recently by the rating agencies who put them on negative outlook. And that's a usual chain of events that is playing out here, and we've seen that. This is nothing new. We've seen that every time. Actually, if you go back as a scholar to sovereign debt crisis and financial crisis, very often intertwined with banking crisis, for the last 30 years, and this is the point that people like Ken Rogoff are making and others, you see this regular pattern re-emerging. We're not seeing something that is totally new. We're seeing the regular pattern play out here, and usually the pattern plays out because markets expect solutions up front, immediately, and very quickly done, and policymakers always optimize the cost of acting versus the cost of not acting, and very often cost of action very early up front with some action that is hugely unpopular with the electorate can lead to a delay of action, and the delay of action in many of our countries has been at the core of why things got worse and sometimes why things got out of hand. And we're seeing pretty much the same play out here in Europe. So let's get a bit more specific about the European problems. The European problems are, and again, this has gone way beyond Greece, but Greece is a good starting point where the market started looking through some fundamental problems and seeing that there is really an incompatibility of policies with long-run sustainability. If you look at Greece and Ireland, the Greek economy had a recession after 2008, after the fall of Lehman and the financial crisis emanated into a global recession of roughly 5% of GDP, which is around the number we had in Germany. But at the same time, Greek deficits over the period 2008 to 2010 increased by an accumulated 35%. Actually, for the Irish economy, it was an accumulated 54%. So just in those 3 years, debt to GDP ratios moved up by 54% of GDP. Clearly an unsustainable adding to debt. And actually, Ireland didn't have a lot of debt when this crisis started because they had relatively low, around 60, actually quite below 60% debt to GDP ratio. But of course, even if you were at 60 and therefore roughly in line with European ballpark numbers that everybody uses prudent, adding 54% within just 3 years just brings you way across 100, and that's everything that's triple digit at the moment in the market, in the bond market, in the sovereign bond market is viewed very critically by bond investors. And I keep saying there is no right to issue debt. There is no right to sell bonds to investors. Bonds will buy investors if they think that first of all, they get the money back, and second, they can pick a yield on that investment. If bond investors have to forego the yield and actually have to worry about getting the principal back, they will never buy these instruments. And so as long as there is no clear solution that basically investments in bonds, which have actually zero capital weight under Basel III, so the regulators don't even ask the banks to hold capital against some of these bonds. So as long as that is the case, bond investors will be shy if there is a risk of a default or not getting the principal back. And the way this crisis has been playing out, as I said, a huge amount of deficit added. But that was not the problem. When you are in a recession, you need to let automatic stabilizers work. So usually your deficits become worse because of unemployment insurance, because of pension systems and all of these things being highly procyclical. So you need to leave those things work. And actually in Europe, most of the reaction in a recession is not done by discretionary fiscal stimulus decisions in parliaments. More than 50% of the fiscal response is actually created by automatic stabilizers like unemployment insurance, which in Europe has a much longer reach, which is more generous relative to wages on the job. And so a lot of what the US needs a fiscal stimulus program for, in Europe happens through these stabilizers. And of course you need to let them work. If you don't, you actually make the recession worse. But it wasn't the big increase in deficits during the crisis. It was basically the fact that they didn't use the good years before the crisis, the 2002 to 2005 period, very wisely. Just to give you a number, even in the period where 2005 to 2007, the Greek economy enjoyed a 10% accumulated growth, they still ran a deficit of an accumulated 15%. Now, running a deficit in bad times because you want to stabilize the economy was not the problem. And I think that focus very often is discussed, but I think it's not the right focus. The problem was that even if you grow at an accumulated 10%, then actually in the good years you should run a surplus if you want to commit, like the Europeans have, to an average have a balanced budget. The market understands that if you run a deficit of 15% accumulated in the good times, you will never be able to have the fiscal space to react and to let stabilizers work when the bad times come. And usually the big policy mistakes, like this time around in Europe, are not done in bad times. In bad times, policies are very often without alternative. The big policy mistakes are always done in the good times. That's when you don't consolidate. That's when you don't lay the foundations to being able to react for the future. And we've seen that play out through Greece and through some of the peripheral countries. And if you look how this will go forward, so it was pretty clear the rules that we had for raking in imprudent fiscal policy in good years, the Stability and Growth Pact, the requirement to run surpluses, was undermined by Germany and France as early as 2002, 2003, when they were at the core of a deficit procedure as a result of the dot-com bubble imploding. The Germans let their automatic stabilizers react. They got what we call a red card from Brussels. Brussels, the EU Commission said, your deficit is too high, and we will have to embark on sanctions. And that's where Germany and France, jointly being exposed to that procedure with many others, kind of overruled and thereby killed the fiscal framework of the Stability and Growth Pact that we had. And that pact was never about consolidating in bad times. It was always about running surpluses and consolidating in good times. So we lost the one fiscal framework that we had in monetary union, and that is the Stability and Growth Pact. Basically, due to Germany and France, the two core countries. And when that happened in Germany and France, policies improved in the two countries. But it was like a green light for all the peripheral countries who had much less of a track record in prudent fiscal policy to let fiscal policy get out of hand in their constituencies. And that's where, for example, Greece has violated the prohibitions of that contract since they start monetary union. There wasn't a single year where they actually ran a deficit below 3%. And if you want to do that, you must have a huge future growth perspective in order to be able to pay back the debt that you accumulated. And the other big problem that happened in Europe is taxing people is hard. Issuing debt in Europe between 2002 and 2007 was easy because financial markets, for whatever reason, totally stopped discriminating between European debt issuers. The Greek sovereign debt issuance traded 10 basis points above the Bund. And to be honest, any bond investor that invested in Greek bonds at 10 basis points over bonds, in my view, deserves losing money. Because basically, if that is the pricing of risk, of differential risk, it's totally mispriced. And when now the bond market becomes very nervous about this and asks for European bailouts of major force, they're asking basically the taxpayer, in my view, to make up for wrong investment decisions of bondholders that priced Greek debt at only 10 basis points over bond the entire time between 2002 and 2007. That's not my understanding of a market economy. My understanding of a market economy is you take decisions as an investor and you face the adverse decisions of those. You face the adverse consequences of wrong investment decisions. This is what we're losing if we're bailing out everyone. And the whole role, in my view, of financial markets is to take risks, to price risks, and to manage risks. If we're throwing an insurance on top of all of these investments when they've gone wrong and basically bailing out everyone, financial markets simply become no risk takers anymore. They will take investments as long as they get a return, and once those returns are jeopardized, they ask for an insurance over that. If that is the case, the role of financial markets, the role that financial markets play, and the role that the actors in that markets have becomes very questionable. So in my view, I'm very much against providing these long-term disincentives for doing prudent investments, for monitoring your risk. If you look at the US subprime market, the same thing happened over here. Investments were made, credit was given to investors where the probability of paying back of the individual borrowing the money was questionable from the start. And then markets started using financial engineering because those that generated the mortgages did not have to control or check the payment over time because they securitized them and sold them to other investors. But we're looking just for those risks. But the entire deterioration of the chain from credit origination to monitoring the counterparty, to actually monitoring the repayment flow, to ultimately getting repaid, that is at the core of credit business, got sliced up in different ways, responsibilities migrated, and in the end, rather than having a system of aligned responsibility, nobody took any responsibility for that investment, because once you were done with your part of that chain, you were actually not had any interest to monitor credit quality. And there is a similarity for me here for European bond markets. If you buy bonds, and there's always a backstop once losses in these bond instruments threaten, where you can sell these to, you will always buy the riskiest bonds as long as you get paid. Once some of them default, you will want to get rid of all of them. So you're creating very cyclical markets where actually risk and returns are totally forgotten. So I'm not in favor, and very often that is sort of attributed to Germans as being too prudent. But I'm actually very much in favor of financial markets doing their role of pricing risk, managing risks, and monitoring risks. And I'm very much in favor of a reasonable assignment of policies. Central banks need to do policies with banks. At least that's in Europe. In Europe, 70% of the funding of investment goes through banks. In the US, it's actually 70% goes through capital markets, so it's just the reverse. If you run US monetary policy, because 70% of the funding occurs in capital markets, the return of treasuries, from which everything is a financial instrument, is priced in the capital market, is a key instrument for ensuring the liquidity and the returns in that market segment and for managing spreads over treasuries, which are at the core of every financial instrument in the US, whatever the market is. So the Fed all along had a treasury-oriented framework. The Europeans have a different framework. We have the banks at the core of our financial system. So refinancing conditions with the banks and repos are the key transmission into the economy, because in allowing banks to refinance with the central bank at lower cost over longer periods of time will bring down the rates at which they charge their clients, be it in credit business, be it in any business, because banks are at the core of the European transmission mechanism, much less so than capital markets. And that's why the European Central Bank has always focused in its history on repo operations, on funding conditions for banks, on collateral operations with banks, and so-called open market operations, rather than outright operations in treasury markets. The whole debate in Europe now is swinging that the ECB should buy huge amounts of sovereign debt in the market. And actually, there are two misnomers that the proponents of those actions, usually players in the financial market or chief economists of banks who are not far from financial markets, because very often nowadays chief economists sit on the trading floors rather than be totally independent. So the question that is posed to the European Central Bank is, why don't you buy huge amounts of sovereign debt to solve the problem? Well, first of all, it's not their job. Second, if you want to make that comparison to the US, it would be as if the Fed were to decide to buy state of California and state of Illinois, just to mention the two states, the one where I work now and the one where I'm visiting now, debt, and decide at the same time that other state debt is not being bought. Because we don't have a European treasury market that is existing at the European level. We only have state debt. What has been transferred in Europe to the European level is monetary policy, and actually it's the only policy that has been transferred to the European level, except maybe competition policy, which is not as key. Fiscal policy and joint issuance of debt instruments has deliberately been ruled out by all European governments before monetary union was started. And that's why we don't have a European treasury market. And those that now ask for a European bond market, the so-called Eurobond, a joint and several issuance, are completely mixing up two different issues. A Eurobond is a joint and several liability. I always portray it as, that's what you do in a love marriage. You're basically all in, both of you. That's not what the Euro was about. The Euro was a wedding contract. And in that wedding contract, it was pretty clear, we keep our finances separate. Now, you can change that if suddenly you grow crazily in love in an arranged wedding. And I think the Europeans are working on that. But it's not the natural. And therefore, the way I see this is, it'll take a long time till that wedding contract, which said we keep our finances separate, and actually we even commit that if the other party spends too much, we will not bail them out. So this is like, yes, you can have your credit card, but if you run into problems, I will not pay up for it. So what is happening now in Europe is questioning these very foundations of the Union. And I'm very concerned about all these debates, for example, like Eurobonds, because I'm a strong believer in Europe, and I want Europe at some point, on some day, to have Eurobonds. That is a joint and several liability that is second to no other currency in the world, including the US dollar. And for that to happen, it has to be a prime instrument, untainted by rescue measures, untainted by everything else. It has to be an instrument where the strongest countries with the most prudent fiscal policy issue that instrument and fully stand behind that joint debt. And for that to be the case, you have to have a process to get there. And that process has to be that you have to define rules on how you organize your expenditure, on how you organize your revenues. And then you have to have a rule on backing up that difference between these two decisions, if it's due to, say, a recession or anything else happening in the economy, backing that up with a joint and several liability. The idea that you let everybody determine their own expenses and claim no interference from anyone else on that decision, and you let everybody determine their own expenditure, and revenue and expenditures are a national issue, and then you say, but the difference between these two decisions, and please don't interfere with those two decisions, the difference between these two has to be picked up by everyone in a joint and several liability. It's not how you would organize real life. It's not how you would organize anything, and therefore you shouldn't organize a monetary union like that. So I'm very skeptical about some of these suggestions that now, in the middle of a crisis, want to leapfrog into joint debt issuance without really clearing the roles and the rules on the way to get there. So yes, fiscal union, which is debated now, and I think the European governments, including Frau Merkel and Mr. Sarkozy, are working on what they call a fiscal compact, about joint rules for decisions, about joint expenditure, joint revenue rules. But that's a long way to a joint debt instrument, and I think they made that clear. Politically, it's unrealistic to expect that anytime soon. I'm going to end on giving you a view on why the European rescues have been so complicated. If you talk about economics of decision-making, there is a very well-known theorem that if you add irrelevant alternatives, they can change the order of decisions. Well, the Europeans took the luxury of adding 10 irrelevant alternatives to what needs to be done, and in the end made everything very complicated, and now they have to exclude these irrelevant alternatives one by one. I just tried to portray one such irrelevant alternative, which is a Eurobond now. It was really dominating the debate for a year. We're now getting to the point where everybody is starting to see, yes, as an idea it's okay if you have the right framework, but as a reasonable thing to adopt now, it's unlikely to happen. So they're taking off the table all of the things that are not likely to happen anytime soon. And if you look at the history of the European rescues over the last 1.5 years, these are 17 countries involved plus the Commission. Everybody's bringing to the table their favorite toy on how Europe should be organized. They had a long debate about this. The market started to ask for immediate and swift action, and the Europeans are now meeting over this weekend. Actually, as we speak, they're going into their summit where they have to come up with solutions. And the market has great expectations for this weekend. The market had great expectations for the ECB meeting this morning. If you understand how politics works, you understand that those expectations are totally ill-footed. Because politics is not about taking bold decisions. Sometimes they have to. If things are bad enough, they will. Politics is about balancing two things: the cost of action and the cost of not acting. And up till now, the cost for bold action, you see that in the basically repercussions in some of the countries in Europe. Just the movement True Finns, just to mention one, is one of them. The cost of bold action has been relatively huge because bold action is refuted by many countries, in particular by those countries that would foot the bill. So sovereign debt crisis has been emanating in the southern periphery of the Eurozone, and most of the funding mechanism actually has at the core the northern countries in the Union. So all we're talking about here is a redistribution within the Union. At a point in time where, when the Union started, it was explicitly said there will be no redistribution, and therefore we don't need joint decisions on these issues. Now, we didn't have the joint decisions, and people are coming back and asking now for joint funding. That's very hard to sell. So, in my view, it will come slowly, but the cost of action relative to the cost of not acting have to increase and have increased reasonably pretty much. So we'll see some more action. We'll see some solutions coming out of the summit and of the ECB meeting, but these will be gradual decisions, taking decision processes one step further. They will not be a final solution, big bang, fix it all. They never are in politics. And you've painfully observed that over here with the debt ceiling debate and with some of the debates you now have about, you know, the medium-term fiscal strategy and how that is playing into the election campaign, and therefore probably we won't see a lot of that coming out. It's the same logic as what we see over in Europe. The cost of bold action and long-term commitments is very high, and that's why usually policymakers kick the can down the road. The problem in Europe is that the probability of doing that successfully is narrowing. And therefore, I think we will see some more action down the road. The world will still exist in Europe after the 9th, even if the meetings doesn't come up with all the market expects. There'll be another meeting. They'll take more decisions, and they continue what they've done so far. They will basically take shots at solutions, but will not fix the problem forever. And so if you extrapolate that out for the next year and a half, 2 years, European markets will continue to be weak. European politics and fiscal problems will be at the core of financial markets. And international bondholders will be shy about buying new bonds because they're feeling they have an overhang, an inventory of bonds relative to where they would now price bonds and relative to the returns at which they're willing to hold risk in European sovereign debt. And that process will continue to go on. So I'm not too concerned about that process continuing. I know that there are some roadblocks that could mean that some hard decisions have to be taken, but as this goes forward, I don't think that will be sort of the working hypothesis for everyone. You can see that because most of the Europeans are still working on the fiscal framework. But working on that fiscal framework, underneath the radar screen of policymakers, the banking situation in Europe has deteriorated quite a lot. And so the Europeans have just run a stress test on how much to recapitalize their banks, given that they have problems. And so what they did is they basically looked at banks' books and said, what if we were to mark down all these assets in banks' balance sheets to the value where they're trading now? And they came up with a stress scenario that says, well, we would need 106 billion additional capital in European banks. The problem with that stress scenario is the stress scenario predicted a very, very mild recession as the adverse scenario relative to a main scenario, which was growth between 1.5% to 2%. The adverse scenario has been overtaken by reality by now. So if you really add an adverse scenario, things will look much bigger, and the capital hole in European banks might look bigger. So European fiscal authorities, because the market at the moment doesn't recapitalize banks, will have to face adding capital not just to solving their own fiscal problems, but they also need some capital to solve the bank problems in some of the peripheral countries. And actually, if you look back to the Asian crisis, to the Mexican crisis, at some point, all debt becomes public. Public debt and bank debt become correlated one-to-one, and Europe is in that phase where bank debt and public debt, and even corporate debt, is correlated very, very highly. So the hole that is opening up in balance sheets, not just in sovereign, is getting larger. And that requires that not just the fiscal compact is needed to be dealt with, there needs to be prudent action on banks. And actually that's where I see the bigger challenge. Because for the fiscal authorities, you have a given calendar of reissuance. Actually, Italian debt, on average, has a 10 to 15-year maturity. So if you're not too concerned about secondary market trading prices, because you're just concerned, of course, they impact on the primary market access. But if you can take a country with a program from the IMF or a program from European peers, if you can make sure that they can reissue all their debt and will not go insolvent, the fact that market prices are skyrocketing, if you give that country exceptional access at different prices to funding from peers, can help you to get across the time. For banks, the situation is different. Once a bank is viewed as having problems, counterparties stop lending to it, counterparties stop buying its assets, and that's where the situation can accentuate quite quickly. And we've seen that here after Lehman Brothers and going out. if confidence in the interbank market ceases to exist, the problem can become a fast-burning problem. And I think, therefore, if the Europeans are heading now into this weekend, the one action that I would like to see most is some action on dealing with the bank problems and making commitments to recapitalizing banks, and then take it from there, make some medium to long-term commitments also for fiscal policy. But the imminent issue that needs to be dealt with much more now than maybe a few months ago is the banking and financial market issue. And you see that on all sides of the market. European banks, because they've been given time to face their capital ratios, are deleveraging. They're selling their US businesses because they're redefining their sphere where they will operate. And basically, if dollar liquidity is hard to get, you start selling assets in dollar space because you want to retreat to your home markets. Banks usually, when they have to survive, basically shut off everything else but the home market. And that is a point where, don't kid yourself, this crisis can take another turn and impact on markets that so far are pretty robust. And that is US corporates, that is US stocks, because if they are defined by European banks as being assets where they will not see the major part of their operations in the future, they'll be the first assets to sell. They'll also be the assets that they can sell without realizing a loss. It'll free capital in the banks, because if you buy corporate bonds, you have to hold capital against it. If you sell corporate bonds in a market where prices are fully intact, you basically get your principal back. You may forgo some interest on that, but you actually alleviate your capital. So what European banks are now doing is basically embarking on strategies to make sure that even in adverse situations they survive, and that is they're focusing their core business on home markets. And they're actually encouraged by some regulators to do that, and that's where I think this crisis is about to turn a new twist and add a new dimension. That is the deleveraging in global markets of European banks, and largely in markets like emerging markets or US markets that are intact, at least for those assets. And we've seen that in the past. The repatriation of funds from Europe leads to some more investment wanting to be done in the home markets of those countries outside Europe. And actually the selling of European assets will make that possible. But it's always a question of how big the additional supply relative to the additional demand is. Because if there's a huge additional supply relative to demand, you will see prices tending down in those markets, and that will affect valuations in everybody's book that needs to mark the market. So this whole thing has a potential of basically inflaming new markets that so far have been pretty robust. And that's why I think the global community needs to encourage the Europeans to move on that banking issue in a short space of time. I'll keep it at that.